Two funds are enough for most people, a safe fund and a riskier global stock fund which generates higher returns. And in this video I'll focus on that global stock fund. There have been some changes over the last year, and this led to me changing the one fund which I hold in my core portfolio. So I'll discuss some of the criteria which allow you to choose the best funds, and at the end of the video I'll discuss what I consider to be the best funds at the moment based on those criteria. Today's episode is sponsored by Freetrade, the commission-free investment platform which is revolutionising the world of investing in the UK market. Let's begin with those criteria which determine whether a fund is good or not. The first choice is whether your fund is active or passive. If it's active, you're paying a fund manager, usually high fees, to select stocks which beat an index, a global index in this case. If it's passive, you're simply tracking that global index, usually for a very low fee. Another choice is whether you include emerging markets. Should global include countries like China, Brazil, and India? It doesn't make quite as large a difference as you might think, but in many cases it does make a difference to the fee that you'll pay. Another choice is whether you're paid an income from your fund in cash in your brokerage account, or whether those income payments are reinvested back into the fund. That's the choice between an accumulation fund and an income fund. Now generally you're better off having a sterling denominated fund, because if you have to convert your cash in your brokerage account into dollars, say, that can be quite expensive on many platforms. So you're probably best sticking with a sterling denominated fund. And that way the fund manager will convert any currency and they can do it much more cheaply than we can. And then finally, we'll choose a fund which has the lowest possible fee. Now starting off with the active passive question, should you pay a fund manager to try and beat the market? The performance for global funds, these are sterling denominated global funds, is simply abysmal for UK fund managers. 95% of them were beaten by a passive benchmark. That means that only 1 in 20 fund managers over a 10-year period managed to do their job and beat the market once you subtract their fees. So I think the evidence here is pretty clear that using a passive fund is likely to give you better returns net of fees. Maybe you'll be one of those lucky 5% and choose a fund that does outperform, but it's unlikely. So assuming you do go down the passive route, the question is which index do you track? There are lots to choose from. The two main providers are MSCI and FTSE Russell. What's a bit confusing about these two index providers is they give different names to world and developed. MSCI has a strange classification where world actually means developed markets. If you want a global index which includes emerging markets from MSCI, it's called the ACWI index, the All Country World Index. FTSE Russell has a much more logical naming convention where the All World Index, the FTSE All World Index, is the global one, that's EM and DM, and then developed markets only is called developed. But once you do make a choice of whether you want developed or developed and emerging markets, I don't think the choice of index provider is very important. Here, for example, is a comparison between the FTSE Russell Global Index, that's emerging markets and developed markets, and the MSCI equivalent index, which is MSCI ACWI, All Country World Index. FTSE All World is in yellow, MSCI ACWI is in blue, and they've given very similar returns over the last decade. There's just a 0.3% annualized difference between the two funds. And that's not surprising because there's only one world with the same choice of stocks in it. If we look at the top 10 holdings of those two indices, you can see how similar they are. The top 10 funds make up 20%-ish of the two indices. And because it's market cap weighted, it's the same 10 stocks. Microsoft is about 4%, Apple's just under 4%, Nvidia's just under 3%, and so on down the list. There will be small changes depending on the precise rules they use for the weightings, but they are very, very similar. And somewhat surprisingly, I think, if you exclude emerging markets, it doesn't make a huge difference to the returns either. Here I've shown two maps of the world, and this is from iShares data. The top one is the map for ACWI, the All Country World Index, which is developed and emerging. The bottom panel is for just developed. That's the MSCI World Index. Now, if you look at the detailed weightings for emerging markets versus developed, EM only makes up 6% of the global index, ACWI. So excluding that 6% doesn't make a huge difference to the returns over the last decade, say. And that's because these EM markets are relatively small. The US is the utterly dominant market, and usually the EM markets are much smaller. And if we compare the total return on two MSCI tracking funds, one which tracks MSCI ACWI, one which tracks MSCI World, so here ACWI is in yellow, it includes emerging markets, and World is in blue, it's only developed markets, notice how the developed market index has outperformed. And that's by over 1 percentage point since 2011. If we push the analysis back further, EM actually adds to performance. But the outperformance or underperformance isn't huge either way. Now, what is true is that if you add emerging markets to an index, it often makes it more expensive to track because these are less liquid stocks, the bid-offer spreads are larger, and that cost is passed on to you as the buyer of the fund. So personally, I don't feel too bad about omitting emerging markets altogether. If you're someone who's very young, then perhaps it would make sense for you to include emerging markets because emerging probably won't be emerging over the course of your life. It'll actually graduate to developed. But personally, I don't have as many years left, so I'm happy to stick just to developed markets and pay a lower fee. Today's video is brought to you by Freetrade, the commission-free investment platform. Are you looking for a new home for your investments? Freetrade has a special offer for you. If you top up or transfer your ISA or SIPP worth more than £10,000, Freetrade will give you a free share worth between £100 and £2,100. But hurry, this offer ends on April the 5th, 2024. Freetrade has taken the stress out of transferring with their purpose-built modern technology. And to put your mind at ease, customers benefit from FSCS protection. Freetrade won Best Online Trading Platform at the British Bank Awards for 5 years in a row, and over 1.5 million investors trust them with their investments. Join today to access over 6,100 US, UK, and European stocks, ETFs, and investment trusts. So how does this offer work, you may ask? Whether you're an existing customer or looking to transfer an ISA or a SIPP from another provider, make sure you open an ISA or a SIPP with an annual standard or plus subscription on or before April the 5th, 2024, and keep your account open with a balance of at least £10,000. You'll be awarded the free share within 90 days. To get started, head over to freetrade.io/transfer or check the link in the description below. Now, although it seems obvious, not all platforms have all funds, so it's really important to check that the funds you want are available on your platform. For example, if you're on the Vanguard UK platform, they only offer their own funds. So for example, you can't buy any iShares ETFs on Vanguard's platform. So given their restrictive choice of global funds, you can see the 9 funds which are available on their website here. The cheapest one, which is developed markets only, is VHVG. So the fee for this fund is 0.12%, and that's pretty competitive. If you don't want the accumulation version, the income version comes with exactly the same ongoing charge, 0.12%. Now, until recently, this accumulation version of the fund wasn't available. They only had VEVE. So when it did become available, I switched into this fund because the fee is low. It's an accumulation fund, which I prefer. I don't have to reinvest all the income payments into the fund. That's all done for me. And the fee was considerably lower than the global fund I had previously. Now, these ETFs aren't only available on the UK platform, you can also buy them on other platforms. So for example, on Freetrade, if I wanted VHVG, it's available here. Or if you wanted the income version, VEVE, that's also available. On some platforms like Hargreaves Lansdown, there's a distinction between funds and exchange-traded funds. You can tell the difference between the two because you'll see the word ETF or exchange-traded fund in the name of the fund. If it's just a regular fund, an OEIC, an open-ended investment company, then it won't have the word ETF in its title. You can also check the Key Investor Information Document, or KID, and that'll also tell you whether it's an ETF or an OEIC. But if you are going to be buying funds, OEICs, on Hargreaves' platform, the holding fee is very expensive if you hold large amounts. And that's because it's a percentage fee. Up to a value of £250,000, then you pay a fee of 0.45%. So let's say you had 250k's worth of a fund. Every year that would cost you over £1,000 in holding fees. Whereas if you held exactly the same exposure through an ETF, then that would cost you only £45 a year. On other platforms, there isn't this distinction between funds and ETFs for their holding fees. So for example, on Vanguard's platform, there's no difference. Now, many of the new platforms are ETF only. You can't buy funds on them at all. And so for these platforms, you don't have a choice of having a fund. So that'll restrict our choices, as we'll see later on in the video. Now let's look at some of the changes in the offerings for UK investors over the last year or so. Now, in November of 2023, Vanguard made available 30 accumulation versions of its funds. Previously, for those funds, you could only buy the income versions on its own platform, which seemed to make no sense to me. But they did the right thing, and they made the accumulation versions available for their investors on their platform. Then in February, Vanguard made available its accumulation version of its money market fund, which was along the same theme. It had an income version previously. Nobody really understood it as well, I don't think, because there you can see the price fluctuating up and down in a kind of ramp shape. Nobody understood why. With the accumulation version of the money market fund, this would go into your safe fund category. There you see the price gradually increase over time, which I think people understand intuitively. However, what we haven't seen from Vanguard is a really large set of fee cuts. I think for their global funds, they could be much more competitive now that they've scaled their offering and they can offer those economies of scale. They have had fee cuts in the past, but it's been a while. However, what we did see in February, which was brilliant, was that the previous cheapest fund choice, which I mentioned, one from HSBC, it's their FTSE All World Index Fund, the fee was cut from 0.13% to 0.12%. They didn't make a big song and dance about it. They didn't even announce it. It was just some members of our community which noticed the difference. So for our premium website members in the PensionCraft community, we offer this web page which allows you to choose the cheapest funds on multiple categories. And that's for US and UK investors. So if we select UK and we also select global equity, you can see a list of the cheapest funds globally. And there are also other categories, for example, cheapest money market funds, commodity funds, and developed market equity funds. And another really exciting announcement was this one from Solactive and from Amundi, which is that they've released a very low-cost global fund. It's an income fund. Ideally, I like accumulation funds, but it is global. It covers EM and DM. It doesn't track an MSCI or FTSE Russell index. Instead, it tracks the Solactive GBS Global Markets Large and Mid Cap Index. Solactive is a German index company. But what's really exciting about this fund launch is the fee. It's only 0.07%. So that's very competitive. Unfortunately, it's not yet available to UK retail investors, but keep checking this space because this could be a really exciting launch. So now let's go through what I consider to be the best funds based on some of these criteria. So if you can buy funds, these are not ETFs, these are funds. You wouldn't do this on Hargreaves Lansdown, for example, because it's expensive to do so. And on an ETF only platform, you couldn't buy this fund. But if you have got access to OEICs, then this HSBC FTSE All World Index Fund remains, I think, the most competitive choice. The fee's been cut from 0.13% to 0.12%, which is great. It's an accumulation fund, it's sterling denominated. If you were going to hold this in a general investment account, when reporting your taxes is easier if it's an income fund that splits out capital gain and income, then the income fund is available, and that has the same management fee of 0.12%. If you are restricted to exchange-traded funds, then I think the FWRG fund from Invesco, this is a FTSE All World tracker, is one of the best choices. The management fee is 0.15%, It's sterling denominated, it's an accumulation fund. An income version is available if you have a general investment account, and this should be available on any platform which has UK ETFs. The cheapest developed market accumulation ETF I know of is this one from LGIM, Legal and General Investment Management, and the fee for that is just 0.1%. As far as I know, there isn't an income version of this fund, but certainly if you've got it inside an ISA or a SIPP on an ETF-only platform and you want to stick to developed markets, I think this is a pretty good choice. And interestingly, this very low-fee fund tracks one of those selective indices, one for developed markets. So perhaps that's the secret as to how these fund management companies can keep the fees low. Maybe Selective charges lower licensing fees, or perhaps it creates an index which is cheaper to track. But if you are after a developed market income fund, then this one from Fidelity is a reasonable choice. It also comes as an accumulation fund, and the ongoing charge for that is 0.12%, so slightly more expensive than the one from LGIM, but still pretty low. And that's exactly the same fee as the developed market ETF from Vanguard, which also comes as an accumulation or an income fund. And this is the fund which I own, which makes up 90% of my overall investments. So I hope that's helped you both in terms of finding the criteria which are important in choosing a fund, but also suggesting some funds which might be best in your circumstances. As you can see, it's not a simple choice. It depends on the tax wrapper. It depends on whether you think emerging markets are going to outperform and whether you want to include them, but also whether you want an income or accumulation versions of a fund. Now don't forget our offer from Freetrade. To find out more about that, go to freetrade.io/transfer or just look at the link in the description below. And, as always, thank you for listening.